Hi, everybody. This is a short course on stock valuation. This is number 7, risk premium part 2. Last time, stock valuation number 6, I explained about risk premium. However, risk premium is a deep topic I need to follow this time also. And you might recall what risk premium is. It's compensation of what you need. If you look at stock price movement, then risk premium would be deviation from what you expect as a stock price movement expectation. Deviation from the expectation is a risk, and standard deviation is a deviation from the expected return, right? Then we think about the gravity of distribution function, center of gravity of the distribution function, and then concluded that risk premium would be the 1/3 of the risk standard deviation. 1/3 of the standard deviation would be a risk premium. However, we have many kinds of risk premiums according to your characteristics as investors. And this is a valuation course, and we freely build up many theories according to our thoughts. And theories you can easily build up by thinking about what you need to compensate. So for long-term investors, they do not care about short-term stock movement, but rather focus on dividend growth rate and future dividend outlook and its deviation risk. In this case, risk premium should be calculated through not from stock price, but from dividend times sequential. And if you're a little bit short-term investor and worries about earnings, quarterly earnings, etc., earnings momentum is more important to you, then compensation should be not stock price nor dividend, but earnings growth, earnings momentum, earnings growth rate, and its deviation is much important to you, right? So now we deal with two kinds of another risk premiums. One is risk premium on dividend growth, and the other is earnings growth, right? And first of all, risk premium on a dividend growth, the procedure is the same as we did in stock valuation number 6. So you just prepare time series on dividend, say N+1 samples, usually 10 to 20 dividend series you get, and from N+1 samples, you get N samples of dividend growth rate, right? Please recall, it's Ln function of dt over dt minus 1, two consecutive dividend series you compare, and between to a logarithm function. And what you do next is get a sample standard deviation from the growth rate. And you might recall that's easily calculated by Excel stodev.s function, standard deviation function, sample basis, right? And finally, you get 1/3 of the standard deviation should be the risk premium. It's easy, right? By this, you compensate your most likely loss of getting worse than expected growth rate. That's one thing. And another risk premium on earnings. And it's a little bit more complicated, but you just prepare sales times series and the cost times series. And I would say S for sales and C for cost. And what's cost in this way? Cost means sales minus net income. And you have n plus 1 sales samples from this. And you can get n samples of sales growth rates, which is Ln function of St over St minus 1. And I would say this ds over s, the vectors of growth rate of sales. And then same thing for cost. N plus 1 cost samples, you get n samples of cost growth rates. And meaning is the same. Growth rate definition is Ln function over 2 consecutive cost series. Yeah, I would say this, the C over C, the cost vectors. And finally, we need to think about earnings growth rate. And earnings, before that, I just put A equals 1 over Ln SC, 1 over Ln S over C. And where S, the newest sample of sales, and C, the newest sample of cost. And D income over income is the fluctuation in terms of net income. So net income growth rate. This is calculated by here. One is, the first term is DC over C. In other words, it's a volume growth, how company put cost greater than ever. So yearly change in company's input of cost. And what's this? A times ds over s minus dc over c. This A times ds over s minus dc over c. It's impact on margin improvement compared with the previous year's margin. For example, if net income margin is 5% and the improvement is 1% in a year, then 1% over 5% would be roughly 20%. 20% is a rate of change in terms of income, right? So first term represent volume growth, and the second term represent kind of ASP, average selling price. I would say the margin improvement impact. So volume, the first term is a volume increase impact, and the second term is the margin improvement impact, and the both together means earnings increase rate, right? The growth rate of income. So growth rate of incomes is if you sort out of this equation, you result in A times ds over s, A minus 1 minus A times ds over c. So sales vectors times A, cost vectors times A minus 1, 1 minus A is change of rate in terms of income. So the last thing you calculate is the standard deviation of these time series. So that the income over 3, which is risk premium on earnings. So homework this time. We have two homeworks. Homework number one, you pick up a certain stock and calculate risk premium on dividend growth. And homework number two, you put up certain stock, a corporation, and you get S&C times series, and then calculate risk premium on earnings growth. That's it. And last thing I would say add is, why are you calculate 2 times 3 S&C? You just pick up only net income times 3, but it's good way to use S&C instead of net income itself, because net income often become negative numbers. And if you get a negative number, you can calculate growth rate because it's a LN function. In LN function, you do not use negative numbers, right? So sales and cost are both positive numbers. And so in that way, we can avoid the possibility of getting negative numbers, right? And only if newest sales and the newest cost as over C is greater than 1, we can calculate risk premium earnings. Okay, thank you. Bye. See you next.